Hey guys, so in this video, I'm going over my top 7 stocks for the month of July 2021. In the last month, I've looked through hundreds of different companies, and this is my list of stocks I think are the best buys right now. I encourage you to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Let's get started. So the first company on my list is Nike, stock ticker NKE. This is an American athletic apparel and footwear manufacturer. Right now, their stock is trading at $155.95 with a 52-week low of $95.11 and a 52-week high of $156.38. Taking a look at their 1-year price chart, we can see that just 1 year ago, they were trading under $100. Up until the start of 2021, they grew significantly in price, and since then, sort of leveled down, but really hit a big spike very recently. Nike has a market cap of $246.396 billion, a PE ratio of 43.81, earnings per share of $3.56, and a very small dividend of 0.72%. They have a 5-year expected price to earnings growth ratio of 1.6 and a price to book ratio of 17.69. Taking a look at their profitability, we can see that they do quite well with a profit margin of 12.86%, and the return on equity is a sky-high 55.01%, which is a very, very good thing. Looking at their balance sheet, we can see that right now they are sitting on about $13.48 billion of cash, and they have a very strong current ratio of 2.72. This means that they have 2.72 times the current assets as current liabilities. Now, it's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are currently rating Nike as a 1.9, meaning it is a buy. And the average analyst price target is $177.01, which is almost 15% higher than the current price of $155.95. So as you guys saw in the 1-year chart, Nike stock surged about 15% a few days ago because the company reported its best sales numbers ever. Just 1 year ago, Nike experienced a loss of 51 cents per share because of the COVID-19 pandemic. Today, its revenue has skyrocketed 96% to $12.3 billion, which greatly surpassed company projections of $11 billion. Nike's global sales shot dramatically, and Nike earnings per share for Q4 hit 93 cents, almost double the previous estimates of 51 cents. Simeon Siegel of BMO Capital Markets marked a price target of $174 per share for this company, remarking that even the Jordan brand, which is a smaller subsidiary of Nike, is itself one of the largest brands in the world. We all have our own firsthand experiences with the success and influence of Nike, and you've probably worn their shoes or their clothes at some point, especially now since their clothing and shoes are making a big comeback. The fact that a company is so widespread and influential and can still continue to put up incredible numbers shows that it has the resources and the personnel to continue bringing profits and to continue excelling within today's market. That's why I'm a big believer in Nike stock, and that's why I will be holding it for a long time. Next up on my list is Zillow, stock ticker ZG. This is an American online real estate marketplace company. So right now, Zillow Group is trading at $124.59 with a 52-week low of $55.86 and a 52-week high of $212.40. Looking at the 1-year price chart, we can see that 1 year ago, they were trading under $75 per share. And until mid-February of 2021, they literally just shot up in value. Since then, we've seen a very big correction, one that I think is just too dramatic, with now trading around $125 per share. Zillow has a market cap of $30.79 billion, an extremely high PE ratio of 544.06, and earnings per share of 23 cents. Looking at their valuation measures, we can see that they have a price to book ratio of 5.6. And then looking at the profitability, we can see that they have a profit margin of 1.55%, and the return on equity is also very low at 1.19%. Looking at their balance sheet, we can see that they have total cash of $4.7 billion, and they actually have a really great current ratio of 6.16. Now, right now, analysts are rating Zillow Group as a 2.1, meaning it is a buy, and the average analyst price target is $183.56, which is about 50% higher than the current price of $124.59. So what's exciting is that this digitalization of house hunting is likely here to stay. The same way that buying groceries might turn fully digital at some point. It just makes sense, and that's also coming from me as a real estate broker, because even though it's going to affect me, I know that companies like Zillow and Redfin are changing the real estate game, which in my opinion was much overdue. Zillow offers a faster and more convenient alternative to looking for homes, and the great news is that people are always looking for homes to purchase. Analyst Jake Fuller of BTIG Investment Banking set a price target of $202 for Zillow, predicting that the company's estimated house sales numbers based on the number of removed listings on Zillow offers will top previous expectations of $720 to $750 million. According to Fuller, the number of removed listings continued to increase throughout Q2 of 2021, which is a positive sign that business is booming for Zillow. Oh, I just wanted to say that there are two classes of Zillow stock. So you have Z, which is the Class C shares with no voting rights, and you have ZG, which is the Class A shares with voting rights. Both trade for roughly the same amount, and it doesn't really matter which one you choose. So yeah, anyways, in the meantime, I'd suggest keeping Zillow on your watch list. And long term, Zillow should continue to be a real estate powerhouse and continue gaining market share in the industry. So yes, this video is about me picking stocks I like, but picking stocks can be quite risky. That's why there are platforms like Wealthfront, which is a robo-advisor investing platform that uses software to build you a globally diversified portfolio of low-cost ETFs. That way, investing can be hands-off and more diversified. Here's how it works. The app will guide you through some questions to determine your financial goals and risk tolerance. And then it's going to design a strategic portfolio of ETFs that's right for you. You can also customize your portfolio by changing the weights of the asset classes and adding new ETFs. You can even build a portfolio from the ground up. For example, if you want to build a portfolio that's more tech-heavy, or maybe you want to put more into travel, or you really care about clean energy, now you can use Wealthfront to build a portfolio based on the sectors you really believe in. Wealthfront offers many account types like retirement accounts or traditional taxable accounts, just like any other brokerage. This is your personalized financial advisor, except it costs way less. And the app itself is very well designed and intuitive to use. They also help you look for opportunities to lower your tax bill through tax loss harvesting. Right now you can get your first $5,000 managed for free with my link in the description, and after that it's just a super low 0.25% annual management fee. Use the link below to check it out. And now back to the video. The next stock we're talking about is Hub Group, stock ticker HUBG. This is an American transportation management company. Right now, Hub Group is trading at $66.35 with a 52-week low of $46.54 and a 52-week high of $74.95. Their one-year price chart shows tremendous growth from 1 year ago, with a slight correction in May of 2021. They have a market cap of $2.284 billion, a PE ratio of 28.86, and an earnings per share of $2.30. They have a 5-year expected PEG ratio of 1.31 and a price to book ratio of 1.94. Their profit margins are pretty slim at 2.17%, and they have a return on equity of 6.85%, which is also not optimal. They're carrying total cash of about $226.26 million, and they have a current ratio of 1.3. Right now, analysts are rating Hub Group as a 2.1, meaning it is a buy, and the current average analyst price target is $76.79, which is about 15% higher than the current price of $66.35. Hub Group offers logistical services such as providing trucks and storage for customers. Because the economy is slowly reopening due to widespread distribution of the COVID-19 vaccine, we can expect more and more commercial activity and therefore more and more transportation and storage required for services and goods. Hub Group has a strong foothold in that niche, so it isn't too far-fetched to believe that Hub Group can experience growth in its businesses for the future. Currently, Hub Group is projected to grow its EPS, earnings per share, by over 50% this year. To add on, their asset utilization ratio, which measures how a company uses its assets to generate sales, is currently at 1.72, meaning that the company gets $1.72 in sales for every dollar used in assets. This ratio is higher than the industry average of 1.23, which can suggest that Hub Group, given its current niche, is more efficient than its peers. And from a numbers point of view and from a basic analytical view, I do think that it's more than fair to be bullish on the stock. So yeah, overall, I think Hub Group, it's a very promising company whose stock can definitely see some growth in the long term. And that's why I will be adding it to my portfolio. All right, next up on my list is Palantir, stock ticker PLTR. This is an American big data analytics software company, and their software is used by the military, banks, police, corporations, and more. Right now, Palantir is trading at $26.63 with a 52-week low of $8.90 and a 52-week high of $45. Looking at their one-year price chart, you can see just how crazy the stock is, and they started 1 year ago under $10 per share, spiked all the way to $45 per share, saw a big correction, and now it's been steadily going up. Palantir has a market cap of $49.978 billion, a 5-year PEG ratio of 9.79, and a price to book ratio of 28.45. This company is not yet profitable, with a profit margin of negative 102.57%, and they also have a negative return on equity of negative 126.56%. In the last 12 months, they saw revenue of $1.2 billion with a year-over-year quarterly revenue growth of 48.8%. And they're sitting on about $2.34 billion in total cash with a current ratio of 3.88. Analysts are very mixed on Palantir, and they are currently rating it as a 3.2, meaning it is a hold. And the average analyst price target is just $23, which is under the current price of $26.63. So while Palantir's earnings have been largely negative in the past, many stock analysts and followers of the market have invested a lot of faith into this company because of its tech. Palantir creates and provides software that compiles large amounts of data and turns it into something more understandable so that people can use that data to get a job done. What's super appealing about this is that Palantir's tech can be used for virtually anything, which is why many analysts have been bullish on the stock ever since it IPO'd. And now the company is starting to show strong signs of profitability. Palantir recently reported that its revenue rose significantly by 49%, and adjusted free cash flow totaled $151 million, which is up $441 million year over year. Analysts are excited about this because Palantir's new free cash flow data means a reasonable price target can be set for PLTR. The massive growth in revenue indicates that Palantir should be an undervalued company, and some analysts are looking at a price target of over $30 for the stock. Definitely be on the lookout for PLTR because they are starting to prove that they are a profitable and successful company. That's why I'll continue to add more of it to my portfolio. All right, next on my list is Kroger, stock ticker KR. This is an American retail and supermarket company. Right now, Kroger is trading at $38.85 with a 52-week low of $30.35 and a 52-week high of $42.99. Their one-year price chart shows a good amount of volatility, and we can see that their price hit a high of just over $36 last year, tumbling back down to the low 30s, and then since then, besides a big spike and a drop in early 2021, it's gone up in value pretty consistently. Kroger has a market cap of $29.06 billion, a PE ratio of 20.14, earnings per share of $1.93, and a mild dividend of 2.14%. They have a 5-year expected PEG ratio of 5.18 and a price to book ratio of 3.19. As is normal in the grocery industry, profit margins are slim at 1.14%, but they do have a pretty good return on equity of 16.37%. Looking at their balance sheet, we can see that they're sitting on total cash of $2.31 billion, but unfortunately they have a current ratio of under 1 at 0.82. Right now, analysts are rating Kroger as a 2.8, meaning it is a hold, and the current average analyst price target is $38.26, which is just under the current price of $38.85. For those of you that don't know, Kroger is a major company of supermarkets that includes stores like Food for Less, Fred Meyer, Fry's, and Ralph's. Recently, Kroger reported earnings which surpassed analyst expectations and suggested future sustainable growth for this company. Beyond its financial success, Kroger also has exciting innovations for the future. Because its customers use its loyalty card to complete in-store purchases, Kroger is teaming up with Microsoft and Roku to assess customer information and data following transactions with the loyalty card. This will help the company analyze customer demand and satisfaction according to specific ad campaigns so that it can better advertise its products and services to its addressable market. They've also teamed up with the European online marketplace company Ocado. This is an exclusive partnership, meaning that Kroger has prevented competitors from getting the expertise and knowledge that Ocado has on e-commerce and digital supermarkets. I definitely recommend keeping an eye out for Kroger stock in the long term. Next on my list is PayPal, stock ticker PYPL. This is an American digital financial services and transactions company. Right now, PayPal is trading at $292.76 with a 52-week low of $164.33 and a 52-week high of $309.14. Their one-year price chart shows substantial growth in the last year, and we did see a high in February with a correction right afterwards, but since then it's mostly recovered. PayPal is a gigantic company with a market cap of $343.914 billion. They have a PE ratio of 66.72, which is pretty high, and an earnings per share of $4.39. Looking at their valuation measures, we can see that they have a 5-year PEG ratio of 2.85 and a price to book ratio of 17.5. Their profit margins are quite impressive, sitting at 22.8%, and they have a very good return on equity of 29.42%. They are sitting on about $13.09 billion in total cash, and they have a current ratio of 1.29. Analysts mostly do love PayPal, and they are rating it as a 1.8, meaning it is a buy, and the current average analyst price target is $312.76, which is a bit higher than the current price of $292.76. So PayPal recently announced that it's going to start increasing the prices of some of its transactions, including PayPal Checkout, PayPal with Venmo, PayPal Credit, Pay in 4, PayPal Pay with rewards, and checkout with crypto. While no one wants to pay more for services, this announcement can be a good sign that PayPal has gained a competitive advantage in its niche, allowing it to hike up these prices with minimal downside in customer satisfaction. After all, PayPal does operate in over 200 countries and regions, and its platform has 392 million active accounts. What's special about PayPal's model is that when more people use PayPal to buy stuff, sellers now have more willing customers. In this increasingly digital world, PayPal makes sense as the future of fintech. The company is up to date with all things financial and even has established a foothold in the world of crypto investments. So because PayPal is reliable, well established, and highly profitable, I'm definitely comfortable holding my PayPal shares and buying more. Overall, I do think that PayPal is one of those stocks that everyone should have in their long-term growth portfolio. Next on my list is Delta, stock ticker DAL. This, as many of you guys know, is an American airline company. Right now, Delta is trading at $42.87 with a 52-week low of $24.38 and a 52-week high of $52.28. Their one-year price chart shows huge growth in the last year from around $25 all the way to over $50, with a small drop back to $43 where it is right now. They have a market cap of $27.422 billion, and since they are not yet profitable, there is no PE ratio. Their valuation measures are also not very good, with a 5-year PEG ratio of 39.29 and a price to book ratio of 57.22. Their profit margin is negative 102.96%, and they also have a negative return on equity of negative 176.16%. They're sitting on about $14.04 billion in cash, and they have a current ratio of 0.86. Now, as far as what analysts are saying, they are rating Delta as a 2.1, meaning it is a buy, and you can see that in the recent month, they have changed their positions to only strong buys and buys. The average analyst price target is $56.83, which is about 30% higher than the current price of $42.87. As we all know, this year has been quite a nightmare for airline companies. And the thing about airline companies is that during good times in the market, their profitability still is largely inconsistent at best. Nonetheless, with more and more people being vaccinated around the world, international travel, which makes up a huge portion of Delta's profits, is becoming safer and more feasible. In fact, just a few days ago, the Transportation Security Administration reported the highest number of travelers since March 2020. If COVID rates start to pick up again, which is possible with the new Delta variant, then we could see another dip in prices. But if not, it does seem that travel is on its way back to normal. And because the COVID crisis devalued Delta stock so drastically, bringing it down to well below 50% of its peak value before the pandemic, I do think that the company now continues to remain undervalued given the recent spike in international travel. Yes, airline fundamentals are shaky and they're actually pretty bad business numbers wise, but we should hopefully see some momentum pushing Delta back to its pre-pandemic levels. This is one of those riskier recovery stocks that I am keeping an eye out on, so make sure to do some more research to learn about the overall recovery stock atmosphere as well as how airlines operate. That way you can have a better sense of whether or not you want to invest in an airline company. Anyways, those are my top stock picks for the month of July 2021. If you do want to get some free stocks, I will drop a couple links below where you can get 2 free stocks with Webull and 1 free stock with Robinhood. These are 2 very great and easy to use stock investing platforms that I personally use. Now, before investing in anything, I want to make sure that you do your own due diligence and spend at least 1 hour researching each and every company that you are thinking about investing in. I'm not a financial advisor, so don't go out there and buy any of these stocks just because it was on this list. That would be quite foolish, and I do want to make sure that you guys do your own due diligence. Anyways, that's it for this video. Thank you so much for watching, and if you enjoyed it, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you again, and I'll see you in the next video. Peace.